Okay, so you can also have expenditures during useful life. And I was just talking about this, and basically expenditures are things that are done to keep the asset working. So maybe you have a building painted, or maybe you put in a new kitchen faucet, or maybe you have the oil changed in your vehicle, or you buy new tires for your vehicle. Those are all what they call maintenance and repairs expense, okay? Now, if you have something that is an addition and an improvement to the asset, or something that has a long useful life, it is going to be put to, you're going to debit the plant account. And I don't think you're going to get any problems with that. But an example of this might be that I worked for a company one time, and it was kind of interesting because the building was built in 1924, and this was in 1990s that I worked there. And the building was fully depreciated. So it had gone through its full life of depreciation, right? Because it was built in 1924. And even though it was something's fully depreciated, you can still be using it, okay? So what was funny though is we had to have a new roof put on, and the new roof was really expensive. Like it was hundreds of thousands of dollars, like $300,000 or something like that, because there was all these structural things that had to be done to make it earthquake proof and stuff, right? So we had to add the roof as part of the plant asset, and we had to depreciate the roof over, it was a 20-year roof or something, over 20 years. So it was kind of funny because on our financial statement, it showed building $0, building roof $300,000. So it's like, oh, we have a roof on our financials, but no building. But that's kind of how it works. So if you had what they call an improvement or an addition to the plant asset, then you would debit the plant asset account. You're not going to see anything like that in the problems here, but that would be what would be done. All right. So buying or leasing, and all this, you're not going to have any questions around this or anything, but all this is really getting into is that a lease is like a contract to use something for a certain amount of time within certain parameters, and then you return it to the actual owner. Generally, leases are not financially prudent. They are not a good thing for people to do. But one reason why companies might do leases on certain things is that they often don't have to have any cash to do it. They have shared tax advantages because they're not listing it as an asset on their books, right? And there's also, it's also frequently done for what they call to reduce the risk of obsolescence. And obsolete means that something will quickly become obsolete. So one thing that you often see that is leased in companies would be like copier machines. Right. Copier machines are usually leased for like maybe 1 or 2 or 3 years, because generally what happens with copier machines is that they will they'll last 1, 2, or 3 years, and right about the time that they are getting ready to kind of go bad, they'll start to just kind of fall apart. It's just like it'll just go through a process. It'll just go through a process where the machines will just start to fall apart. So not only that, but it's also the idea of technology improves so much. So that's another reason why companies might lease equipment, because the technology goes so quickly that they can't. It's cheaper for them to lease than to continue to buy new equipment to continue to replace what they have and keep the technology current. So some companies even lease computers. They'll lease computers. So, okay. So now we are going to talk about depreciation. So depreciation, what depreciation really is you're taking the expense of an asset and you're spreading it out over the life of that asset. All right. So if you have a car that costs you $20,000 and you believe it's going to last you for 10 years, instead of having $20,000 on your expenses for that year, the year you bought it, you would depreciate $20,000 over 10 years. So you would depreciate $2,000 a year over 10 years. So you would move $2,000 of the asset into you would put it as depreciation expense and you would credit it to accumulated depreciation. And you would do that over the life of the asset. And the reason why you do that is that way back early in the class, we talked about expense recognition and revenue recognition. And we said that we need to have a connection between the expenses and the revenues, right? So if we have a truck that we're using for deliveries over 10 years and we're creating revenue by using that truck, then we need to have the expense associated with using that truck in that period. So we shouldn't have the entire expense from that asset happen in the very first month that we buy it. It should be spread out over the revenue producing life of that asset. And that's why we do that, so that we have a connection between the asset expense and the revenue that's produced through that asset. Let's see, what does it say here? It's not to, some people say, oh, it's to save money to buy another asset. No, it's not about that. It's just to have the revenue producing ability of an asset recognized over the decline, because its revenue producing ability is going to decline over the asset's useful life. And it applies to land improvements, buildings, and equipment, but not land. Land does not depreciate. We already talked about that. Okay, so there's factors that we need to know in order to compute depreciation. The factors we need to know in order to compute annual depreciation. So hold on one second. I'm going to put my cat in the other room. Okay, so we need to know the cost. All the expenditures necessary to acquire the asset and to make it ready for intended use. Now, you're going to have some problems where you have to figure out the cost of an asset, but when you really get into the problems for working the depreciation, they're going to tell you what the cost of the asset is. You're not going to have to figure it out, okay? You're also going to need to know the useful life. The estimate of the expected life based on, well, there's a lot of different things that come into the useful life. The great thing is in this class, they are going to tell you what the useful life of the asset is. So that's awesome. Then we have the salvage value. And the salvage value is what you think you're going to get for that asset when it's done with its useful life. So you're going to have a truck at the end of 10 years. Do you think you could sell it for $1,000? Well, that's your salvage value. The other great thing, you're going to get the salvage value for all your problems in the class. So they're going to give you the useful life. They're going to give you the salvage value. You may or may not have to figure out the cost, but usually when we get into the depreciation problems, the cost is figured for you, okay? And you've already seen this when we worked on the classified balance sheet, but depreciation is expense is reported on the income statement, right? But when we did the classified balance sheet, if you can think way back to that, I think that was chapter 2, you'll see that it would show the asset, and then right below it, it would say less accumulated depreciation. And we'll see that again. So there's different types of depreciation methods, okay? Some common types are the straight line method, the declining balance method, and the units of activity method. So I'm going to show you the declining balance method and the units of activity method, but the one that we are going to be using for all of our problems is the straight line method. And it is the method that is most commonly used for calculating depreciation, all right? So this is we're going to use this problem to help us to illustrate for you the 3 different methods of depreciation that are used. And this is in our book. So Bill's Pizza purchased a small delivery truck on January 1st, 2020. The cost was $13,000. The expected salvage value was $1,000. The estimated useful life in years is 5 years. The estimated useful life in miles is 100,000 miles. So they want us to compute depreciation using the following methods: straight line, units of activity, and declining balance. Now remember, you are only going to have to do problems with straight line. I'm showing you units of activity and declining balance so you're aware of what they are and how they're done, but you're only going to have to do straight line. So for a quick moment here, I want to stop the share on that, and I want to go back to that Excel sheet. And I want to share with you the process that we had listed in the Excel sheet, remember? Because this is where we are in this process, okay? We are right here. Figure annual depreciation. That's where we're at, the very beginning, step 1. And I could probably add some additional steps in here now that I'm thinking to help this to work out better. Do I want to do that? Do I want to confuse the issue? Figure annual depreciation. That's a separate step. I think I'm going to do a separate slide on this for figure annual depreciation. So to figure annual depreciation, what you do is you start with your cost less the salvage value. Salvage value. And then you divide it by the number, or you divide it by the useful life. And I guess I could put that over on that sheet, huh? I can put that on. So it's cost minus salvage divided by useful life. And you will need this. Okay, I'm actually gonna take that over and I'm gonna put it over here on the steps. Oh, it's not gonna let me, okay. Cost minus salvage divided by useful life. And that's going to give you the depreciation amount. Okay. So I'm going to take you back now to the slide that we were looking at, because we're going to do that here. So we have the cost of $13,000, right? So here's how we do the depreciation expense for each year, the annual depreciation. We take the cost, $13,000, minus the salvage value of $1,000. That gives us what they call a depreciable cost or a depreciable base, okay? You take the depreciable cost or the depreciable base and you divide it by the number of years or the useful life. In this case, it's years, 5 years. And that's going to give you an annual depreciation expense of $2,400, okay? So cost minus salvage gives you the depreciable cost. Depreciable cost divided by useful life gives you the depreciation expense for each period of the useful life, okay? So that reminds me, I'm going to go back over to the Excel sheet because I missed a word in there. Cost minus salvage value. I'm just adding this in. It would still be the same thing, but depreciable base, or what they call depreciable cost. It could be called either. Divided by useful life gives you the depreciation amount. Okay. All right. So let me go back to the slide. Sorry, I'm going back and forth, back and forth. Okay. So that's straight line. Okay. Now that's straight line for what the depreciation expense is for 1 year. Now it gets a little more complicated though, because you have to go through that whole process of asking if the depreciation is current and all that stuff. So this is just figuring out the depreciation amount. Okay. Now you don't need to know this part. Don't write this down. This is just more info. I mean, you can write it down if you want to, but it's not going to be on the test. It's not going to be on the homework. Oh, sorry. This is just showing you what happens if you buy it at a, when you buy it, how your journal entries happen each year. It's showing you how that plays out. So with the straight line method, you would do the same amount, $2,400 every year. And so the book value would go down. You don't change the value in the books, right? The purchase price, the historical cost of it still shows on that equipment, and that's the $13,000. But you're technically able to figure out what the book value is because it shows on your financials, and it's subtract $2,400 every year, because see how the accumulated depreciation goes up $2,400 every year until you get down to the end, which is the book value of $1,000. And that's the salvage value, equal to the salvage value, okay? And the entry you would make for every single time that you did the depreciation entry, you would debit depreciation expense $2,400, and you would credit accumulated depreciation $2,400. Okay, that's the entry you make every time you do the depreciation entry, okay? All right, so let's go to the next one. All right, go to the next one. This is showing us what happens if we have one where we buy it at a different point in the year. So this one is showing us how, what would happen if we purchased the truck on April 1st versus January 1. So we generally do not purchase our assets on January 1. We purchase them throughout the year. So this is just kind of showing you how the depreciation figures out. And we're going to learn how to figure this out, but it's just kind of showing the breakdown of how it still comes to $12,000. But the first year, it's only 9 out of 12 months. And the last year, it's 3 out of 12, because the last year, it's going to be all of January, all of February, all of March, and then on April 1, it's done, okay? Now, the next slide is giving us an example. On January 1, and this is in our book too, Do It 2A. On January 1, 2022, Iron Mountain Ski Corporation purchased a new snow grooming machine for $50,000. The machine is estimated to have a 10-year useful life with a $2,000 salvage value. What journal entry would Iron Mountain Ski Company make at December 31, 22 if it uses the straight line method of depreciation? So it's in the book on page 911. So it would be a cost of $50,000 minus a useful life of $2,000, right? And that takes it down to $48,000, which is your depreciable cost, divided by the useful life of 10 years, means our annual depreciation expense is $4,800. So we would debit depreciation expense $4,800, and we would credit accumulated depreciation $4,800. Okay? And that is in the book on page 911. It shows the answer there too. So, okay. Now, this is the one that you don't need to remember. This is one where we're just kind of showing you, showing the idea behind it. So declining balance, what happens is that they recalculate the depreciation amount every time they do depreciation, and they use the new book value as the basis for their calculation. So here it started at $13,000. They figured their depreciation rate was 40%, right? So the first year, the depreciation expense was $5,200. So that took the book value down to $7,800. That's that first line, all right? Then they take the $7,800 and they multiply that by 40% the next year, and they say the depreciation expense is $3,120. So once they do that booking, then the book value comes down to $4,680. So then they keep recalculating every year based on the new book value. And the idea behind this is that the first year you use the asset, you really get more revenue producing ability out of it. So you have a higher percentage of depreciation associated with that revenue production, depreciation expense. And the older the asset becomes, the less able it is to produce revenue. You know, if you have a truck with 150,000 miles, it's likely going to break down more than one that's brand new, right? Now, this is, again, showing a partial year. You don't need to worry about that. Now, the units of activity one is a really interesting one. Another one that you don't need to know, but, you know, just be aware of it, but you're not going to be tested on this or anything. So what they do is they take the depreciable cost, $12,000, and they, so started at $13,000 cost, right? Minus the $1,000 salvage gives us a depreciable cost or a depreciable base of $12,000. They're going to divide that by the total units of activity. So they're saying how many units they think this is going to produce. For machinery, it might be how many hours of production the machine is going to produce. So in this case, it's a truck and they're saying 100,000 miles. So they're saying that the depreciable cost is 12 cents per mile. So then what they do is they actually multiply the actual number of miles driven each year to get the depreciation. So this is actually really the most accurate, I think, as far as how much the asset was used. So you'll see here that it shows that, the first year they drove 15,000 miles. So that came out to an $1,800 expense. The next year they drove 30,000 miles. So it came out to a $3,600 expense, and so on and so forth. So that's showing that. And again, you don't need to know that method. So if we go down to the next slide, it's just kind of showing you the comparison of the methods and how with the straight line method, your depreciation is consistent throughout the life. That's the red line, the line that goes straight across. With the declining balance method, you have more depreciation expense in the beginning, and then it tapers down as you get near the end of the life of the asset. And with the units of activity, it goes up and down based on the use of the asset. Okay, so I'm going to stop there, and then we're going to go on and do a problem.